Most people have the wrong beliefs about investing in stocks and it ruins their decision making. Let me break one belief straight away which is so accepted it's almost treated as fact. Between the Dow Jones and the S&P 500, the average return for the last 12 months has been around 10%. And common belief number one is that the average individual investor has no chance of beating the market. They say finding stocks that will beat the market, that's too difficult for you. You're not a professional. But let's look at the data. Take the largest 100 US stocks and you'll find 67% of them beat the market over the last 12 months. In the top 500 stocks, that was 60%. And even from the top 1,000 largest US stocks, 54% of them beat the market. Which means, the truth is, even if you just completely randomly picked a stock 12 months ago, the odds are that stock would have beaten the market. That's without even filtering down to the good businesses. So it's not that difficult, is it? And don't let anyone tell you it is. You can beat the market, but some of the main barriers to doing so are these very false beliefs that cause investors to make bad decisions. And this video is going to fix that. That data I just showed you, it had a dual purpose, because it's going to help break belief number two as well. Did you notice the best performing cohort was the top 100 stocks? 67% of them beat the market. Well, let me show you this too, because it's super interesting. Let's just take the top 5 stocks from 5 years ago, 2020. I'll put a list here. No doubt you'll recognize them. And in 2020, they would have been some of the most obvious investment choices you could make. Pretty boring, really. Well, here's their share price gain since then. All of them beat the Dow Jones. And only Amazon lost out to the S&P 500. On average, they achieved 140%. Hopefully this breaks belief number two that you need to find hidden gems. You don't. You need to find good businesses trading at a fair price. And there are lots of great investment opportunities to be found in large cap stocks. If you're a new investor especially, just stick to the S&P 500. You don't need to go looking through small cap stocks in order to win. Now I'd categorize this third belief as one of the most common, and it's dangerous because it gives you the completely wrong mindset. Buy low, sell high. That phrase should never be in the mind of a long-term investor, because it focuses on share price fluctuations rather than the fundamentals of the business. So what do you do instead? Well, let me give you this scenario. You buy a share in a business at $100 a share. Its PE ratio is 25 and its PEG is 1.5, and the business fundamentals are fantastic. Great growth, high margins, no debt. Perfect. A year later, and the share price is killing it. It's gone up 100% to $200 per share. The person who believes in buy low, sell high, they're chuffed, 100% return. And so because the price is high, they sell. But not you. You're an intelligent investor. You notice that the PE ratio is now 19 and the PEG is 0.9 and business growth has become even faster. The price might be higher, but it's become an even better buying opportunity. You don't sell, you buy more. And over the next 10 years, that stock goes up 1,000%. That's not theory. It's reality. It's happened time and time again. Microsoft, Amazon, Meta, to name a few. The best investments are the ones that you buy, and then buy, and then buy. Because the business itself is solid. If you try to play the game of timing stock fluctuations, you'll lose. Base your decisions on the underlying data and the quality of the business's products or services, not the fluctuations of a share price chart. Belief number 4 is that you need to be contrarian, which is basically when you focus on out of favor stocks, ones that are currently underappreciated by the market. Now don't get me wrong, that can work. One of my latest investments is Uber, and it's slightly contrarian because most people probably think that automated cars are going to wipe Uber out. Whereas I think that the business's fundamentals are extremely strong and the evidence points to automated cars actually benefiting Uber because they're the middleman. Kind of like Amazon, they connect the product, the car, doesn't really matter who's driving it, with the customer, you. And they're currently in trials with numerous automated car manufacturers to do exactly that. But the vast majority of my portfolio is very much not contrarian. Stocks like Microsoft, Amazon, Nvidia, Meta. Companies everyone knows are good, but even looking at just the past 12 months, I'm still outperforming the market by almost double. Because often, if a business looks good and everyone agrees it's good, probably is good. Because investing isn't about trying to be smarter than everyone else. I don't try to be smarter than everyone else. It's just about finding great businesses, trading at a fair price. It's really as simple as that. And that brings me on to a fifth belief, which is like a curse for new investors. Everyone seems to go through this stage. I know I did, and it can ruin your first portfolio. And I think it's mostly this guy's fault. Warren Buffett. Well, not directly. It's more people misunderstanding Warren Buffett's message. Because when most people start to look into investing, they look at what Warren did, very sensible thing to do, and they see the words value investor. And then they start trying to find deep value stocks. But the reality is, for the last 40 years, finding deep value stocks hasn't been Warren Buffett's strategy, and it certainly hasn't been his advice. New investors would be much better served understanding how to identify great businesses. Solid growth, low debt, strong cash flow, great products and services. And then understanding when those businesses look overvalued so that you can buy the ones trading at a fair valuation instead. You could absolutely build a great portfolio without even trying to find undervalued stocks. The problem is new investors think their portfolio should be entirely undervalued stocks, which more often than not actually means their portfolio is just full of really bad businesses that no one wants. Stocks do not need to be undervalued to be good investments. The next one is a really strange belief because most home investors doggedly believe in it. But if you look at the advice from legendary investors like Charlie Munger or Peter Lynch, they advise you not to do it. And it makes a lot of sense not to do it. You see, most investors seem to think you should buy a wide range of stocks in order to diversify your portfolio, but you shouldn't. Let me show you why. Let's say you diversify your portfolio over 20 individual stocks, and you spend just half an hour a month checking up on each one. Well, that's 10 hours a month for the rest of your life. That's a big commitment. It's a lot to keep track of, and it's not even the main problem. Because once you get down to your 18th, 19th, 20th best idea, are they really good ideas anymore? Or are you now just trying to find a business for the sake of diversification rather than because it's actually a good investment? It's way more effective to have a portfolio of less than 10 stocks. And then, if you want to diversify and lower your risk, just introduce an index fund as a big chunk of your portfolio, not more individual stocks. That way, you can still reduce the overall risk through diversification, but you can also focus on the very best ideas for your individual stocks. Which leads me nicely into the seventh belief, and this is a super important one to understand. Rebalancing your portfolio is a very popular idea, and the general theory goes like this. Having one or two stocks dominate your portfolio is a risk, so when one gets too large, sell it off and reinvest into either new stocks or the existing stocks in your portfolio. You've probably heard and read that advice. It's very popular and it's kind of dumb. Imagine a portfolio with just 5 stocks, and the investor says he doesn't want any single stock to represent more than 25% of the portfolio to lower his risk. He looks again a year later and panics. 4 of them didn't really grow, but one of those businesses is doing fantastically well. Oh no, disaster, it's tripled in price and now represents over 40% of the portfolio. And so he quickly sells it down to a more comfortable 20% and reinvests into the other 4. Can you see the pure madness in doing that? Assuming the fundamentals of that stock are still solid, the absolute last thing that you should do is cut your winning stock and then reinvest into the 4 losers. You don't sell stocks because they're going up. The only reasons for rebalancing your portfolio allocation is if the fundamentals of the business change or a better opportunity comes along. You don't need to set a random limit to your stock allocation. I'll break belief number 8 for you straight away by showing you this chart. It's the S&P 500 since 2010. If you looked at all the headlines for any of these periods, they would have made it feel like the end of the capitalist system itself. And if you looked at the headlines in these periods, they'd have told you that stocks are at unprecedented and irrational highs and a collapse is around the corner. This cycle never ends. And economic forecasts, journalist opinions, and media hype, they're just noise. That's not to say they're always wrong, but it was Paul Samuelson who made the famous and very dry statement that the stock market has predicted 9 out of the last 5 recessions. His point is, forecasts and the media are almost always overly pessimistic. If you listen to all this noise, you'll never invest because it'll always look too risky. But I'll tell you one economic fact that's definitely true. There has never been a single year in the history of the stock market where some businesses have not gained in value. Drown out the noise and focus on the business fundamentals because macroeconomic forecasts and media opinions don't really matter very much. But if that doesn't convince you to avoid macro forecasting and media noise, breaking this next belief will. Because let's be honest, the only reason we get concerned about economic forecasts and journalist articles is that we're scared that when we invest, the market will just drop. Well, I just did that. I invested in a stock here. 6th of Jan 2025. Pretty much the worst time to have invested in the market at any point, certainly over the last 3 years, because pretty swiftly after, the market dropped 19%. And it's still down just under 5%. But as I described in my last video, the stock I bought on the 6th of Jan is actually up around 40% because it was a great business at a great price. The belief that the market is just too high, it's overvalued, just wait till the market crashes. That belief is never correct when you're investing in individual stocks, because there will always be individual businesses that are good investments, no matter how high the market is as a whole. Now, this final belief is very commonly held by, I think, two categories of people. Ones who tried investing in the past, almost certainly did very little research, and got badly hurt. And secondly, people who are frankly probably just a bit too scared of losing money to risk investing. So both of those convince themselves that share price moves are random. They're caused by market makers and shady dealings. The average Joe investor, they have no chance. Now, I show loads of data on this channel which proves that's not the case, because the evidence shows that high growth, financially strong businesses which are fairly valued tend to experience strong share price gains. I built a free stock screener which automatically categorizes stocks into various strategies based on their fundamentals. It includes 3 of my own strategies which help me identify those great investment opportunities. I'd particularly recommend looking at the stocks in my balanced risk strategy and any stocks that meet all 7 criteria in the lower risk strategy, although none do right now because it is pretty stringent. Investing in good businesses at fair prices, it does tend to bring you pretty good returns. It's not random. And if you want to learn more about the metrics which indicate great businesses and great investments, even at market highs, then watch this video here where I show you exactly how I do that.